Thank you for joining us today. And again, thank you to our special guest today, Carolyn Rogers, the Senior Deputy Governor of the Bank of Canada. Thank you for joining us, Carolyn. You know, one of the things we do at Calgary Economic Development is really about facilitating important conversations. And I honestly couldn't think of a more important conversation today with the Deputy Governor than what's happening right now. If you look at the announcements that were made a couple of days ago, if you look at what happened in Europe this morning with the interest rate hikes, this is a very timely and significant discussion, and we're thrilled to have you here. So thank you again for making the time. This is also one of the first in-person speeches that the Deputy Governor is going to give, and frankly, she's been at the bank since last December, and prior to that, she was working in Europe. She was part of the working in Basel on the, I can't remember, sorry, Carol, I just blanked out. She was working with the Deputy Governor of Bank and first major speech, private sector. She was, it was the Basel Committee on Banking Supervision before coming back to Canada. And again, this is such an appropriate place for the Bank of Canada to have this update for us. Our economy is growing. We're a future-focused city. We're an engine for national growth, a global financial center, a community of committed people who are really, really here to help solve global challenges. And so we're thrilled to be able to have this conversation today in these unprecedented times. We're fortunate to have the insights of the Senior Deputy Governor today, and I want to ask you to please join me in welcoming Carolyn Rogers to the stage. Sorry about that.
Thanks, Brett. These days, I can barely remember what I was doing 10 months ago either, so don't worry about it. It was the Basel Committee on Bank Supervision at the Bank for International Settlements. First, good morning. Thanks for being here. Thanks for the opportunity, the invitation to speak with you today. As Brad said, this is my second public speech since joining the bank's Governing Council mid-December of last year, and I'm really pleased to be out west this time. I grew up in Western Canada, and over the course of my career, I've lived in every province from Manitoba west to BC, including spending some time here in Calgary. And harvest time is approaching, which is my favorite time to be out west. It's a time of year that holds a lot of promise and brings back many fond memories for me. The best part of coming out to make these speeches is spending some time hearing from people like you, so I'm really looking forward to the next day or two where I'll have a chance to hear perspectives from business leaders like yourselves on the Alberta and the Canadian economy. But first, I'm here to offer you some of the bank's views, particularly on the economy and on monetary policy. I plan to cover three things this morning. First, I'll spend some time discussing our current outlook on the Canadian economy and on inflation specifically. The Consumer Price Index, the CPI, was 7.6 in July, down just slightly from June's rate of 8.1%. While it looks like we might have seen the peak of overall inflation in Canada, inflation excluding gasoline prices has continued to rise and broaden across goods and services. There's also some uncertainties, particularly in global commodity markets, that could set us back. And although most days it feels like the pandemic is in the rearview mirror, we're heading into winter, and that means more time indoors. If we've learned anything in the last 2 years, it's to expect the unexpected. Of course, the second thing I want to talk about is our recent rate decision, our decision yesterday. We raised the policy interest rate by 75 basis points, and of course this came on the heels of July's decision to increase the policy rate by a full percentage point. In total, the bank has increased the policy rate 3% since March. I'll spend some time explaining why we have chosen to front-load rate increases and why we think this has been and continues to be the right response to the current underlying causes of inflation in Canada. The third and final thing I'll spend some time on is the path forward. I hope to give you a sense of the things that the bank will be monitoring closely, the signs we'll be looking for to guide our next decisions in the months ahead. Monetary policy takes time to affect the economy. The decisions the bank makes now and the ones we've made in recent months will take up to 2 years to have their full effect on inflation. But in the meantime, there are indicators we look at along the way to help guide our decisions, and I'll try and shed some light on those today. I'm going to begin with how our views on the economy have evolved since July, because that'll help me set yesterday's decision in context. Let me start with inflation. Global supply challenges and elevated commodity prices continue to contribute to inflation here in Canada. In addition, demand continues to outstrip supply in many parts of the Canadian economy, and short-term inflation expectations of Canadians remain high. As long as that continues to be the case, there will be upward pressure on prices. Many Canadians experienced this over the summer. We all tried to make up for the last 2 summers of missed vacations and family gatherings. They faced limited options and higher prices when it came time to book campsites, car rentals, hotel rooms, plane tickets, even dinner reservations. And price pressure is not limited to discretionary items like vacations and restaurants. In fact, some of the biggest price increases we've seen have come on things like groceries, gas, and rent. These are all things Canadians need to buy on a regular basis, so it's impossible to escape the frustration and the stress that inflation brings, especially for those who are living on low or fixed incomes. High inflation is affecting businesses too. Inputs, things like raw materials, intermediate inputs, and labor are all more expensive. While businesses can try to pass on higher input costs by raising prices, inflation creates uncertainty that can affect investment decisions. In the long run, this puts downward pressure on productivity, and it prevents businesses and the economy as a whole from growing. Although CPI inflation came in slightly lower in July, this drop was due almost entirely to gasoline prices. If we exclude gas prices, inflation actually increased and spread across components. In fact, more than half of CPI components grew more than 5% in July, and the bank's measures of core inflation continued to move up. All of them were at or above 5 in July. This shows us just how strong underlying inflation remains in Canada. Turning to the broader economy, it's evolved largely as we expected it would when we published our July monetary policy report. Consumer spending was very strong in the second quarter, with a recovery in hard-to-distance sectors boosting spending on services in particular. Early indicators, things like restaurant and hotel reservations, suggest that demand for services will remain strong in the third quarter. Housing resales have dropped from unsustainably high levels during the pandemic, and house prices have been adjusting downward, with the largest price declines occurring primarily in the areas of the country where they increased the most over the last 2 years. On the business side, a surge of imports of machinery and equipment in the second quarter points to strong business investment in the second half of the year, and the export outlook remains positive too. Alberta's economy has certainly benefited from this strength, as well as from higher oil prices, both of which should boost investment and exports in energy and other commodity services. The labor market remains very tight. The unemployment rate is at an all-time low, and we're still seeing significant labor shortages across most sectors. With more than 1 million current job vacancies in Canada, demand from employers remains very high. Softer global demand for goods is contributing to some improvement in supply chain bottlenecks. Global shipping rates have declined considerably in recent months and are now about 50% off the peak in September 2021. And supplier delivery times and backlogs have continued to improve in July across most regions in the world. While the global picture is encouraging, supply constraints remain widespread here at home. Canadian businesses tell us they're just not yet seeing major relief on the supply front. Taken together, the data over the past 2 months point in one direction. The Canadian economy continues to operate in excess demand despite the recent pullback in housing, and inflationary pressures are increasingly broad-based. This leads me to our decision yesterday to raise the policy rate by 3.25%. This is the 5th increase to our policy rate since March. The speed and the size of these rate hikes have been unusual and we know Canadians are anxious to know whether they're working as intended to bring inflation down. We also know that for many Canadians, higher rates are adding to the burden they're already facing with high inflation. But raising interest rates is necessary to bring inflation down. Higher rates make borrowing more expensive and savings more attractive, leading consumers and businesses to spend less and save more. As people spend less, overall demand in the economy declines, and this will give supply a chance to catch up. Because we're in a period of excess demand, we need a period of lower growth to balance things out, to bring demand back in line with supply. The reduced spending that results from this rebalancing will ultimately help us lower inflation. Monetary policy works a bit like a chain reaction or a sequence of events, and that sequence takes time. Both history and research tell us that changes to the bank's policy rate affect different households and different sectors of the economy differently and at different speeds. If you're making a big purchase or an investment, one that requires a loan, you'll feel the impact of higher rates almost immediately. And the sectors that are most sensitive to changes in interest rates are the ones that cool first. The housing sector here in Canada is a clear example of that. Most of us take out a mortgage to buy a house. An increase in mortgage rates may cause us to delay a purchase or purchase a less expensive house. This leads to a slowdown in housing activity, and as housing activity slows, people tend to spend less on the things that go with houses, furniture, other housing-related goods. On the other hand, it takes longer for monetary policy to bring down price growth in other goods and services, especially in services, because they're typically not related to borrowing. Instead, they adjust over time as spending overall moderates. Let me focus in a bit now on our deliberations leading up to yesterday's decision. Of course, Governing Council discussed how the economy had evolved since July. We noted that while Canadian and global economies are showing early signs of slowing, the Canadian economy is clearly in excess demand. GDP growth in the second quarter was slightly weaker than we predicted in July, but consumption and business investment grew at a significant pace. Labor markets remain very tight and inflation is broadening. With short-term inflation expectations remaining high and all three of the bank's core measures of inflation moving up, we discussed the risk that ongoing inflation becomes entrenched. If that were to happen, higher inflation becomes self-fulfilling and a damaging cycle would be set in motion. We want to ensure this scenario does not materialize. The economic cost of restoring price stability will be much higher if it does. This led us to our decision to raise the policy interest rate by 75 basis points. By front-loading rates now, we're trying to avoid the need for even higher rates down the road and a more pronounced slowing of the economy that would go with it. Given the outlook for inflation, we continue to judge that policy interest rates will need to go higher still. As the effects of tighter monetary policy work through the economy, we'll be assessing just how much higher rates need to go to return inflation to target. Let me turn now to the path ahead. So going forward, our focus will be to judge how monetary policy is working to slow demand, how fast supply challenges get resolved, and most importantly, how both inflation and inflation expectations respond. I'll spend just a couple minutes on each of these three things. On the demand side, we'll be keeping a close eye on how global developments and commodity prices affect exports and business investment and how this translates into pricing decisions. As higher inflation and interest rates constrain household budgets, consumer spending should moderate in both goods and services. However, we know Canadians have accumulated extra savings during the pandemic, so there is a risk that consumer spending has more momentum than we suspect and might make inflation a bit more persistent. As labor demand eases from excess levels, pressure on wages and prices, and therefore on inflation, should recede. And of course, we'll continue to monitor the adjustment in housing activity and prices. On the supply side, unexpected global events could further disrupt supply and push prices up even more. We'll be watching to see if supply disruptions are improving, especially in hard-hit sectors like motor vehicles. Will improvements to supply chain bottlenecks continue? And how quickly will this translate into an easing of supply constraints and therefore lower costs for Canadian firms? Similarly, the bank will continue to monitor a broad set of indicators to see if labor shortages are subsiding. Finally, as demand and supply come back into balance, we'll examine how inflation and inflation expectations respond. This includes looking at the near-term momentum, in particular our measures of core inflation, to assess how broad and entrenched pricing pressures are. Meanwhile, survey results will help us see if the short-term inflation expectations of consumers and firms are coming back down. This will be a really important sign that monetary policy is working and Canadians are beginning to feel some relief. Given the lag between changes in interest rates and the impact on inflation and the considerable amount of uncertainty surrounding the outlook, getting inflation all the way back to 2% is going to take some time. We also know there could be bumps along the way. This is why our ongoing and careful assessment of the economy and inflation is so important. We remain resolute in our goal to reestablish low, stable, and predictable inflation. Canadians should be able to plan their spending and saving decisions without having to worry about the rising cost of everyday essentials. So let me conclude by going back to where I started, harvest time in Alberta. As a kid, I spent a lot of time on my grandparents' farm, and I remember my grandfather telling me he needed 3 eyes at harvest time. One for the weather, one for the calendar, and one for the crops. And I also remember long days and long sleepless nights until the crops were off the field. It feels a bit like that at the Bank of Canada these days. We have a careful eye on many different things. We have a lot of work ahead of us, and we will not rest easy until we can get inflation back to target. We're determined to get the job done.
Thank you so much. That was fantastic. Appreciate that. So now we're opening the floor to questions, both from the floor. We have people online who are submitting questions. If you do have a question, we have people with microphones who are able to take your questions. So do I have anybody on the floor before we go to the online questions? Not yet. So Governor, Deputy Governor, sorry.
You just promoted me.
Deputy, I promoted you. Yes. After that speech, why not? You mentioned in a speech in June, you said we need better transparency about climate exposure by businesses and financial institutions. We also need clear transition plans by global policymakers. Together, these can help mitigate the risk of disorderly and painful transition.
Yep.
That hurts both our financial system and our economy. So are we still seeing the signs of a painful and disorderly recovery?
Well, I think the war in Ukraine, I think, has caused a lot of reflection on the transition path. I mean, we were really focused before then on an aggressive transition path. I think what we've seen now is most countries around the world are reflecting on energy security as well as the transition path. That doesn't change the fact and the points that we made earlier. It is the bank's very strong view. We put out a paper on this earlier this year. We did some work with one of our federal partners, the Office of the Superintendent of Financial Institutions. So it's our very strong view that getting out ahead of this transition, getting policies in place will make for a much smoother, more planned transition. What we don't want is to see sort of dislocations, unexpected bumps along the way. So we continue to think that transition's necessary, but it certainly has been complicated by what's going on in Ukraine.
Thank you. I did warn Carolyn that this group was not shy, but apparently you're making me look bad because I'm not seeing any questions right now. I have one question at the back.
Hi, thank you for the speech, first of all. And if you don't mind, I have 2 questions. Okay. First question is, you mentioned that this is going to be a 2-year plan, and what metrics will be used to see that we're on plan and we're not getting away, and if something happens, that you to go back on plan? And then the second question is, you mentioned that there's a shortage of employees. So my understanding is that there's going to be an immigration changes for more people to come into the country. And as an immigrant myself, I was wondering, how will higher interest rates impact the decision making of those immigrants coming into the country? Will they be more open, or my thought is maybe they will be less open to coming here and then working and spending more interest?
Okay. That's an interesting question. Well, I mean, what I would say is inflation is a global phenomenon right now. So I think it's something that's happening in all parts of the world, and in fact, I think the inflation rates in Canada are lower than some of the major jurisdictions in the world. Whether that affects the decision that people make on immigration, I don't know that I have much of an insight on that to offer. But I will come back to your point about immigration being one of the sort of relief valves to the high level of the pressure in the job market. That is the case. Immigration has fallen off in the last couple of years. We do expect, as it comes back again, it will provide a bit of relief in the job market. To your first question, I mean, I guess I would clarify what the 2 years is a reference to. Is what we know is that it can take up to 2 years for the full effect of monetary policy to occur in the economy. It has to work its way through. It's that chain reaction or sequence of events that I described in the speech. So I don't know that we have a 2-year plan. We do have. We are aware that the decisions we're making now won't have an immediate effect. They will take some time. So that's why I laid out sort of the number of indicators that we look along the way to see whether things are evolving as we expect.
Thank you for that. We have a number of questions now. There we go. We have one over here first, and then we have 2 on this side.
Hi there, and thanks for your comments today. I've really appreciated them. I'm wondering if you can expand a bit on the notion of inflation becoming entrenched. In particular, you seem to think we're not necessarily there, but seeing inflation hit the service sector so strongly, I'm wondering, A, why you don't think we're necessarily in an entrenched space yet, or maybe there's some gradient to unpack, and B, if it does become entrenched, how can we see the plan evolve from there?
Sorry, the last part of your question?
Yeah, how would the plan evolve to fight inflation if you see it or perceive it being entrenched?
Okay. Well, so to the first part of your... Actually, let me back up and just maybe elaborate on this point a bit. I mean, I know there's been some discussion about this lately. So what we've got now is a combination of high inflation, excess demand, and a super tight labor market. And what happens in that environment is employers are really focused on attracting and retaining the employees they need. They're looking at the excess demand they've got for their products or services, and they're trying to hire the people to keep up. And that can lead to wage pressure. That's completely understandable. Employees, on the other hand, are looking at the same very tight labor market, and they're looking at the effect of inflation on their budget, and they're saying, look, I need a raise. So also completely understandable. It's not the Bank of Canada's job to provide advice on wages or prices. That's not our role. But it is our role to make sure people understand how those decisions affect the path of inflation. The scenario that we're worried about, what we call entrenched inflation, is when businesses and consumers start to look at the current rate of inflation and they make the assumption that that's here to stay for the long term, and they start making decisions with that assumption embedded. If that happens, that's what we call entrenched inflation. What happens in that scenario is inflation becomes sort of a self-fulfilling prophecy. It becomes, wage pressure becomes sort of an independent sort of source of inflation. We want to avoid that. To your question of what happens, monetary policy has to tighten a lot more to get inflation back down when you've got that kind of spiral happening. So that's why we're focused on avoiding it. The front loading of interest rates is one of the key strategies we think that will help us avoid that. I think the other question you had is, how do we know that it's not entrenched yet? We do a lot of our own surveying with businesses and consumers, so we're getting real-time feedback on what they see. We've also been looking at some of the private sector surveys too. Certainly, inflation expectations are up. That makes sense. Inflation's up, and it's been up for a while. Ultimately, the best way to get inflation expectations down is to get inflation down. So that's what we're focused on doing.
Thank you. We have another question. This gentleman right behind you, Sean, I believe. Who was? There we go. Sorry. Thank you.
Good morning, Tom Holloway, University of Calgary. Your own bank and global central banks seem to be quite bought into the idea of front-loading and mention research about how front-loading is better. Can you help us understand that research a bit? Maybe it's from historical experiences or something like that. Thank you.
Yeah, I mean, I think you probably saw the ECB announcement today. I think they used the same term. There was the research that most of us are referring to was done actually by the Bank for International Settlements. It's online. You can have a look at it. I think a big part of it is back to the question the gentleman asked me just before, which is making sure people have a sense that the bank is focused on getting inflation down, trying to stave off that sort of expectation spiral that we're seeing, trying to bring demand down quickly so that it doesn't run too far ahead of supply. The research that we cite is publicly available. I can, if you'd like, afterwards I can point you in the direction. And we can debate it if you like.
Fantastic. Thank you. I think Deb Yedlin, President of the Chamber of Commerce, has a question.
Thanks very much, and thanks for the comments. I guess just to piggyback on what was just asked, I mean, that front-end loading, what are the risks that you overshoot? And you actually, economic growth is compromised more than you expect it should be. And so I have one question. The second one is, you mentioned the amount of savings that are sitting on the sidelines still, and do you have a sense of the timeline of when that might be dissipated? What kind of impact could that have? Could that offset some of what we're talking about right now from an economic growth perspective, because people will continue to spend?
Yeah. Well, I'll take your second question first. I mean, Canadians have accumulated a lot of what we call excess savings more than they normally would have over the pandemic. And as I said in my speech, one risk to the outlook is that sort of props up high levels of demand and spending longer than it might otherwise in a rising rate environment. That would sort of make inflation a bit more persistent. We've been watching it for a while now. We keep thinking Canadians will draw it down. We haven't seen a lot of that yet, but the effective rate increases are just starting to take hold too. So, we're watching it closely. Back to your first question. I mean, there's a lot of risks. We have said this from the beginning. It's a delicate balance. The economy right now is very strong. There's a lot of excess demand. Unemployment's at a record low levels. So, we think there is room to cool demand and keep the economy in a positive state of growth. Is it tricky? Absolutely. It's absolutely tricky. Yeah.
Thank you. Do we have any other questions right now? One of the questions that's come in was something you mentioned in one of your previous speeches, which is to say that the Bank of Canada can be a little bit mysterious. Can you shed a little bit of light on that mystery?
Well, as some of my friends will say to me when we get going, stop talking economist to me and start talking English. I think it's there's parts about, particularly about monetary policy, I think, that are not intuitive. The idea that a lot of people are saying to us now, help us understand how increasing the cost of my mortgage, increasing the cost of borrowing, is helping me with the cost of living problem I have with inflation. I mean, and I completely understand that question. It's not an intuitive thing to understand. So, I think the bank puts a really high priority on communicating, helping Canadians understand monetary policy. We've always done that. When inflation is 2% for decades on end, as it has been, it's hard to get people interested in wanting to understand monetary policy. They don't need to know how it works. They just know it does. And so they've got other things they are interested in knowing. Right now, people are really interested. And so we're putting a lot of effort into being less mysterious, into making sure that any Canadians that want to engage with us, that want to understand monetary policy, have the chance to do that. We think we're the right place to get information, and so we're trying to put a lot of information out right now.
We were having a conversation before about the distribution mechanisms around getting that information to a younger audience.
Yeah.
Can you talk to us a little bit about, I know we've seen some social coming out of the bank now, a little bit of that. Can you talk a little bit about the thinking around how to get that message into sort of our youth's hands so they get a better understanding?
Yeah. Well, that's exactly it. Nowadays, social media is a place where some people exclusively get their information. So I had a conversation with my nephew, it was around Christmas time, and I said something about the Globe and Mail, and he said, "What's that?" So, just, So yeah, we need to go where Canadians are, and Canadians of all stripes, of all generations, of all interests. So we have been ramping up our social media campaign. We've been bringing in more expertise in that area. We've been trying to leverage some of these, for us, I'd say new tools. I think, Twitter's hardly a new tool, but we're trying to put more effort into our social media campaign. We're trying to meet Canadians where they are.
Fantastic. I think Mr. Lougheed has a question.
Well, first of all, Joe Lougheed, Chair of Calgary Economic Development, and I want to thank everyone for being here today, and thank the Senior Deputy Governor for being here, and welcome back to the West. My question, of course, monetary policy and interest rates are a pretty blunt instrument, and we're a very large country. How does the bank look at regional economic perspectives in setting these factors? And certainly you'd have a lot of data on the forecasts and prospects for the West and Alberta in particular. So what are the bank's views on Alberta and our economy in the medium and longer term?
Yeah, well, Alberta is and always has been an engine of innovation and economic growth in Canada. We were having this conversation earlier this morning. That continues to be the case. I'm glad that's your phone, not mine, because usually I forget to turn my phone on. But you're right. Monetary policy is a blunt instrument. We have one policy rate. We don't have a policy rate for different provinces. We know that. The best thing we can do to make sure that we're getting a full picture of the Canadian economy is this kind of thing, to get out in the regions. We have regional offices across Canada. Calgary is actually, I think, our largest regional office. We have a big team here. I'll be spending the next couple of days, as I said in my speech, hearing from people like you. That's a huge part of what goes into our decisions. We take in all kinds of data and analysis and models, but a big part of the presentation the Governing Council gets on every single decision is our regional staff come out and say, hey, here's what's happening in Alberta, here's what's happening in BC, here's what's happening Montreal. We always take that feedback on board. It's very important to us.
Thank you. We have one question at the back.
Yes, thank you. I just have a quick question. So, in the last decade, the Canadian dollar has a strong correlation with commodities, especially crude, right? And that's what kind of was our offset for inflation, right? So, obviously, as we know, the spike in crude prices back in February during at the start of the Russian-Ukraine conflict, there hasn't been that correlation of rising the Canadian dollar against the U.S. greenback. With the further tightening of the monetary policies, do you think we're going to see an increase of our currency going up, or?
Yeah. Well, the first thing I'd say is the bank doesn't forecast on currency. That's not something we do. But what I would say is we've observed the same thing you're describing. Normally, rates would go up and price of oils go up, you would see some investment coming into Canada, you would see the Canadian dollar tick up, and it would provide an important buffer on inflation. We haven't had that buffer. So, you know, I was reading some commentary yesterday. There is an expectation for the Canadian dollar to go up. We'll see if that happens. It would be nice to get that buffer.
We have one question over to the right.
Thank you. Welcome to the West again, Deputy. I'll use
Thank
that,
you.
just Deputy.
That's good for short. Yeah.
Thank you for speaking. Maddie McMillan, she, her, they, them. I work with the Petroleum Services Association of Canada, so we know a lot about energy, labor shortages, and supply woes. You mentioned about 3 I's with Gramps in, eye on the weather, calendar, and crops. I was wondering if you could speak on the eye, on a 4th eye on the horizon. You have a room full of smarties listening to a smarty. We're not the only country facing inflation, and we've spoken domestically. What do you see from what you've seen and read? What do you see puts us at competitive advantages or opportunities for the smart folks in the room here to go and tell all their buddies to go and act and fight inflation? Thank you.
Well, I mean, you know, I think, as I was saying to a previous question, you know, inflation's a global phenomenon right now. Almost every country is dealing with at least some level of inflation, and lots of countries are dealing with the levels of inflation higher than ours. In most cases, those are countries that import some of the things that we have here at home. So one of the advantages Canada has right now is we produce the things that are in short supply in the world right now. We don't have to import them the way other countries are, and that's certainly giving us a bit of an advantage, both sort of on the economy as a whole and on inflation.
Thank you. And I think we have time for one more question. I believe, Deb, you have one more question for us? Oh, was there somebody else as well?
Sorry, this will
I
be
can
quick.
do one more after this.
Okay.
When inflation started to run, a lot of people were looking at what was going on and saying, well, this is supply, you know, it's supply chain driven. It's the destruction of the global linkages from a trade perspective. It's transitory. In your perspective, when did transitory become, we have to start raising interest rates because this is actually more than something that is passing, sort of coming out of the pandemic?
Well, that's easy. That was March, right? That's when we raised interest rates. Yeah, I mean, this, yeah. You know, it's difficult for me to say because I was in between jobs around, I think, the time that a lot of this, you know, so to speak on behalf of the bank on that question is a bit difficult for me. You know, what I can say is central banks around the world took this position on transitory because that's what supply shocks usually are, right? Usually supply shocks, even if they last a while, they do usually dissipate. And what we've learned over the years is if central banks react too quickly to those supply shocks, you actually, you create turbulence. You can do more damage than good. And so I think that was the thinking around the supply shocks. I think, you know, what we have learned since then is when those supply shocks come as a result of a pandemic, when they're that widespread, they're that global, they're that disruptive, and then they're followed very quickly after by a war in Europe, they're very persistent. So, you know, if it's clear in our speech and in what we're saying, we do still see, we do still expect these supply shocks will dissipate over time. But, you know, I think when we were using the word transitory, people thought, well, they're going to go away soon, right? And so, you know, we're off that message for sure.
So one more question, and someone's just going to bring the microphone to right there. If you could just stand up, please. Thank you.
Hi there. I just had a question a little bit more about how you view monetary policy along with fiscal policy. We're seeing GST rebates come out. You've had the UK come out potentially with an affordability of energy. But how do you look at that from a monetary policy, especially when you're raising rates?
Yeah, that's a really good question. So, you know, people are really concerned about affordability. And so there is a lot of pressure on governments to help, particularly people with low income, with what is really a lot of pressure on affordability. So we understand that. Governments are weighing a lot of priorities. They have to balance a lot of things. You know, we do need help on the fiscal side to get inflation down. It does need to be a joint effort, but we completely understand that there's some pressure on affordability. Ultimately, our job is inflation. That's where we're going to stay focused. And we're going to get inflation back to 2%.
Fabulous. That's all the time we have right now. So please, ladies and gentlemen, for Carolyn Rogers, thank you so
Thanks
much
for the
being here.
questions.
Good morning. My name is Rebecca Spence, Press Officer at the Bank of Canada, and I will be moderating this press conference. Senior Deputy Governor Carolyn Rogers will be pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone, which my colleague will bring to you if you raise your hand. We also have some journalists participating via teleconference today, so we'll do one question in the room first and then turn to the phone lines to try to make sure everyone gets a chance to ask a question. Avant de poser une question, prière de vous identifier, je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions de la langue officielle de votre choix. So we will start in the room with Chris Varco.
Hi, Chris Varco with the Calgary Herald. We've seen in the last 8 weeks oil prices globally fall from about $100 to $85 a barrel. I'm just wondering, what do you see as the impact this will have upon the Canadian economic outlook going forward through the rest of the year on investment levels and then ultimately on the rate of inflation?
Yeah, thanks for the question, Chris. As I as I outlined in my speech, certainly that fall that we saw in gasoline prices over the summer contributed to the downturn we saw in inflation. CPI went from 8.1 to 7.6. So that has helped bring the pressure down on inflation. Apart from that, though, as I pointed out in my speech, inflation has broadened and has increased. So certainly it has helped. What I would say is commodities in general remain volatile. So there's still a chance that we get pressure back up in the other direction. But certainly if gas prices stay down, it'll help inflation, headline inflation.
Are there any other questions in the room before we go to the phone lines? All right, seeing none, we'll go to the phone lines now. I just want to remind people on the call to mute their line if they're not asking a question. You can do so by pressing *6 and unmute by pressing *6 again, or using the mute function on your mobile device. Pour mettre votre ligne téléphonique en mode discrétion, appuyez sur *6. We're going to start with Julie Gordon from Reuters.
Hello, Senior Deputy Governor. Sorry, it's a bit echoey. Can you talk us through the decision basis points instead of another point? Please.
Oh, sorry, Julie, you're cutting in and out. We didn't get the question.
Okay, I'm going to try doing it this way. Can you hear me better now?
Yes, yeah.
Okay, sorry. So the question was, thank you, first of all, Senior Deputy Governor, for taking our questions. And my question was, if you could just give us some context on why you decided to go with 75 basis points instead of another 100 basis points. What changed?
Well, let me, take you through the decision a bit. A lot of this is in my speech, Julie, but, I think we start every deliberation by looking at what's developed in the economy since our last decision and relative to our outlook. So certainly we did that this time. I would say the three things that really stood out for Governing Council on this decision was, first and foremost, probably inflation is staying high and inflation expectations are continuing to stay elevated. And also, of course, the Canadian economy remains strong. We're in excess demand. As long as that's the case, you're going to see upward pressure on prices. So, overheated economy, inflation's high and broadening, our core measures were all up, and expectations remain high. So those three things, I think, were really key to the decision that the Governing Council made yesterday. We have seen some early signs that monetary policy is working. I talked a lot in the speech about the lag in monetary policy, but certainly there's some early indications. Interest rate sensitive parts of the economy, the housing market is, of course, the obvious example of that, have seen some pullback. GDP was a little lower than we expected, but spending and investment remained high. So, in total, what we saw was a continuing pressure on inflation. We're not where we were in July, but we're a long way from where we need to be. So those were the things that really fed into the decision yesterday that we took.
Thanks, Julie. We'll go next to Mark Rundle with the Globe and Mail.
Hey there, can you hear me?
Yes.
Perfect. Thank you so much for taking the question. I noticed that you mentioned that you're going to need a period of lower growth to balance things out and kind of work out this excess demand. And I also noticed that there was no sign or no mention of a soft landing in today's speech, which differs from how Governor Macklem talked about it in July. And I'm wondering, I guess, does the bank still believe this soft landing is possible? And does the comments about the necessity of lower growth entail a likely recession?
Okay, I think you were a little hard to hear, Mark, but I think I caught the gist of your question. So, look, the Canadian economy remains strong. We're at record low unemployment. We've got 1 million job vacancies available. We think there is room in the economy to cool it and stay in positive growth territory. That's our base case. Certainly, we do need, as I pointed out and you mentioned, we need a period of moderation on growth to let demand come down, let supply come back up, and rebalance the economy. The bank still sees a path to a soft landing. That's still our objective. We need to cool the economy to get inflation back to target. Of course, we don't want to cool the economy more than we have to. We continue to see a path to a soft landing. As the governor has said many times, and I said again this morning, is that path narrow? Is it a delicate balance? Absolutely. Ultimately, our goal is to get inflation back to target. We're focused on that, but we're going to do it in the best way possible.
Thank you, Mark. Just for any reporters who are late in joining the call, if you have a question, let us know by sending a quick email to communications@bankofcanada.ca and we'll put you in the queue. Pour les journalistes qui se sont joints à l'appel avec un peu de retard, envoyez un bref courriel à communication@bankducanada.ca si vous souhaitez poser une question. We'll go next to Greg Quinn of Market News, followed by Eric Hertzberg from Bloomberg. Go ahead, Greg.
Hello. I was wondering if Governing Council is still looking at monetary policy relative to any kind of neutral interest rate, or if perhaps you've shifted, like Jerome Powell, to the view that, you know, when inflation is so high, that kind of a theoretical concept isn't as helpful.
Well, we've said in the past that we thought rates needed to get into neutral territory quickly. And we estimated neutral to be around 3%. We were starting from a very low point, so it took a number of big steps to get up into neutral territory. But neutral is a range. It's an estimate. There isn't a sort of magic formula that gives us neutral rate. A lot of it is sort of state dependent, or depends on the environment we're in. I think the thing that the Governing Council is most focused on is getting inflation back to target. We don't have a target for interest rates. We have a target for inflation. That's the target we're focused on, and we're determined to get it back to 2%.
Thanks, Greg. Eric?
Yes, so a question regarding front-loading here. Are forceful actions larger than 25 basis point hikes still on the table here, or is the era of outsized rate hikes over for the Bank of Canada?
Well, I mean, I'm here to talk about the decision we made yesterday. We took another big step yesterday. We have said and continue to say that we think front-loading is the best way to deal with the underlying causes of inflation and to navigate towards that soft landing that we want. We'll take the next decisions with the information we have in front of us at the time. And we talked today in the speech about the kinds of things we'll be looking for as we make the next decisions. But we'll take the next decision when it comes.
Thanks, Eric. We're going to go next to Tony Mace of Mace News, followed by Najoud from the Canadian Press. Go ahead, Tony.
Thank you. I wanted to ask about wages and your level of concern about the possibility of a wage price spiral, given some of the data we've seen recently on rising wages and some wage settlements. Thank you.
Yeah, I mean, I talked about this morning during the Q&A, and I'm glad to have the question. It gives us a chance to make some important clarifications on this topic. So we're in an environment of extremely tight labor markets, excess demand and high inflation. And we know employers are very focused on attracting and retaining the employees they need. They need to do that to keep up with the high level of demand for their products and services. Of course, this is going to put pressure on wages. We understand that. We also understand that workers are, they're looking at the rate of inflation and what it's doing to their purchasing power, their budgets, and they're looking at the same tight labor markets, and they're thinking, I need a raise. this is also completely understandable. It's not our job to provide advice on wage or price setting. We're talking about this topic because we want Canadians to understand how these decisions affect inflation. The scenario that we're worried about is that Canadians look at the current rate of inflation, they think it's here to stay, they start incorporating that thinking into long-term decision making. That's the sort of spiral that we talk about, that's the entrenchment that we talk about that would be damaging to the economy. Certainly, if that starts to occur, it makes inflation much harder to get down. It means monetary policy has to do more, rates have to go higher to get inflation down. So of course, we would like to avoid that. We think Canadians would like to avoid that too. So that, that's our aim in sharing that information. We'll be watching wages closely. That was one of the things I pointed out in the speech. Really what we need is that supply and demand to come back in balance across the economy, and particularly in labor markets. That'll take the pressure off wages.
All right, we'll go to the Canadian Press now.
Hi, thanks for taking our questions. In your speech, you make mention of the fact that it will take time to get inflation down and that there could be bumps along the way. Can you elaborate a little bit about what you mean by bumps? Is this in reference to what the impact of slower economic growth could be or how severe it could be?
Yeah, I think I talked about some of the risks in the speech and in the questions after. I mean, we're still in an environment of uncertainty. There's still a number of things globally that could have an effect on inflation globally as well as domestically. So certainly the war in Ukraine is keeping commodity prices really volatile, and it's also having a sort of general effect on confidence. In China, we're seeing an ongoing effect of COVID lockdowns. That's also putting pressure on supply. So some of the same things that have affected us and have impacted inflation to date, those things they haven't gone away. So they're still out there. They can still have an effect on inflation here in Canada. Domestically, we see really strong demand. We need to get that demand down and give time for some of the global effects on supply to work their way through. Let supply catch up, get that balance back in the economy. That's what we're aiming for.
All right, thank you. So that's the end of my teleconference list. I just want to open it up one last time for the reporters in the room. We have time for one more question if anyone here would like to ask. If not, for the purposes of fairness, we'll call it there. Thank you all so much for coming today, and have a great day.